The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the finest financial show, or 1 hour on the radio.
The number one ranked show in the Metroplex.
I wish it was. I know everybody out there wishes it was 2 hours or 10 minutes, one or the other.
Yeah, one or the other, right?
Remember, I'm Victor McClure. I'm the host and the president of the Dillon Gage Wealth Management Companies. For those of you new to the show, we do pretty much everything except real estate around here. We do stocks, bonds, insurance products, annuities, car insurance, homeowners insurance, business insurance of any kind, health insurance. You name it. We've done it for a long time.
And we employ
business since the 80s.
And we employ a team of experts in each field that we work in.
We believe in specialists. Instead of a general practitioner, we believe in specialists. What is our specialty? Our specialty is retirement planning. We have a philosophy that if you have so many bills, cover your hard expenses at least with a guaranteed income payment. So if you got $5,000 in bills, well, how about $5,000 or $6,000 coming into your bank account every single month?
Absolutely. And not the only answer to that, but something that fits hand in glove. What do we save our 401ks or IRAs for? It's for retirement. It's an income stream. We've talked about it at 70.5 with your required minimum distributions, your RMDs. It becomes a forced income stream. So that's an excellent place to start to look to generate the income.
That's right. I understand the tax ramifications of it, so you want to delay it as much as you possibly can in there. But if they're going to force an income stream on you and possibly deplete all of your retirement assets, might as well get a good income stream, even if it does deplete, make it keep going no matter how long you live. My co-host forgot to introduce you, Guy Allard.
That would be me.
Remember, if you have any financial questions, let's say you'd like to take advantage of our no cost, no obligation retirement analyzer, which what it does is gives you a retirement stress test. Trust me, if you saved $1 million, you make 30% a year, you're fine. It's when you don't. Does that mean at 80 you're eating cat food? That's what you need to know. You need to know what inflation is going to do to your expenses over time. I'm not talking about scary in 70s or early 80s inflation. I'm talking about normal, typical inflation. What does that do? Because nobody in the world can tell me the electric bill is going down over the next 10 years, or the water bill, or anything else, or the food at the grocery store. So you need to factor that into your retirement plan. These plans that we produce at no charge can really illustrate what your life is going to be looking like 5, 10, 20, even 30 years into retirement. It's a really good window into knowing how is this going to work. And if you're within, say, 10 years of retirement, it's really crucial in my opinion. I don't like this winging it thing where I think it's going to be okay as long as I get there. Nah.
And the more time you have, if you see us and you're within 5 years of retirement, we can do some great things. We can help. But the 10-year number that Victor mentioned a minute ago is really a great number. If you can see us 10 years before you need that income stream, we can almost double what that income stream would be for you.
And don't remember, if you're 1 year retirement, 2 months from retirement, or in retirement, we can also help you as well. Don't hesitate to call us at 972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. All right, Guy, before I get into it, we're going to talk about the different income-producing investments, like your bank accounts, your municipal bonds, your investment-grade bonds, real estate trust, preferred stocks, dividend-paying stocks, all those kind of things. But first, we want to talk a little bit about Prince.
Oh, yeah. Well, before that, I was going to ask you. You always come on the show, and you mention that you're president of the Dillon Gage companies and all of that, and I'm thinking that maybe my title should be mentioned, and I'm thinking of changing it. What do you think? I've been the senior wealth manager here for years, and what do you think about senior fiduciary?
There you go.
Does that sound better?
Sure.
All right. I just want to get that out there.
The fiduciary, maybe?
The head fiduciary. No. We're talking about Prince a little bit. It's something that we're all familiar with, but unfortunately when a megastar dies, it reminds us of the things. You've probably heard the news that Prince died without a will. and thought we'd take a few minutes, maybe talk about the ramifications, the problems, the issues that it causes for family. Now, these numbers are going to be big. We're going to talk about Michael Jackson in comparison and Elvis Presley, because as they died, their fortunes dramatically increased with their deaths. So they're big numbers, but it's very important for everybody. You don't want to let the federal government decide who gets your money and how much it's going to be taxed. But let's just take a look at some numbers and what's going on with Prince. Now, they're saying right now that at his death, or the time before his death, his fortune was worth about $300 million. The problem is, at Michael Jackson's death, his fortune was worth about $400 million, but immediately became $2 billion in taxes, or in value, and then they taxed the $2 billion. Where Prince lived, in Minnesota, they also have an additional 16% state tax that's done statewide.
That's on top of your 35% tax?
40. They said his total tax would be 56%.
Ooh.
Now, think about the issues with that, Vic. On $300 million, let's just use 50%. His heirs have to come up with $150 million to pay the IRS. Cash. And everything's not liquid, right?
Right.
We talked about Joe Robbie Stadium. When he passed away, his heirs had to sell it because they didn't have the money. Now, let's take that and extend that problem. If they say that the value of his artistry, his music, and all of the stuff that's not even yet produced is worth $2 billion, like Michael Jackson, just using a 50% deal, now his heirs would have to come up with $1 billion. The whole estate's only worth $300,000.
$300 million, yeah.
Or 300, what did I say?
1,000.
$300 billion? Or 1,000. So the whole estate's only worth $300 million. If they had to come up with $1 billion because the IRS is assessing future value of his works, how do you do that? Plus, when that estate generates that future income, doesn't it get taxed anyway?
Absolutely.
It does.
The government has got their hands in everything, and they want more of it. And they're talking about future values. Well, we think it's going to be worth this much. You got to pay us this much more in taxes. The 56% up front wasn't good enough.
It's crazy.
You got to sell everything and to hope to get 50, because I know 300 million is a big number, but they don't have 300 million in cash. There's a whole bunch of other stuff. They have 20 million in cash. I mean, to come up with 150 million is a big deal.
And the point is, no one wants to burden their heirs with the issues. We've helped many people go through this, both with trusts and all sorts of things. We've got a very good trust attorney that we use at offices downtown. So anyway, if you don't have a will, get one. If you don't have your will updated, please take a look at it and make sure that it is doing what you want it to do for you and your family.
Yeah, you got to make sure. I understand 300 million is very foreign to everyone, including myself. But think about it in another context. What if your family had a car dealership or something like that?
Right.
And your family, your grandfather, your father, now they passing away, it's you. And you've got this giant tax bill. It's already been taxed 2 or 3 times at change of hands, right?
Absolutely.
And you've got to come up with this money. Is it fair that the government gets another 50% of it and then have to coming up with cash, which is not easy to do if you own a business, coming up with that kind of cash? All right, I own a business. And somebody asked me, well, the business is worth this. I need the cash tomorrow. Well, I mean, you have 9 months. But
right.
I know sometimes they'll work with you, extend a little bit, but that's still a lot of pressure. They've had people sell a lot of businesses, ranches, all kinds of stuff. And you got some old families that have owned these ranches for, decades. They might have bought the whole thing for $3,000, and now it's worth, $50 million or something. All right, give me the $25 million in taxes. You're like, holy crap.
And one compound that. I know it's hard to feel bad for somebody who has a $300 million estate. But again, if they value the future earnings, which is crazy, at $2 billion, families got to come up with $1 billion. There's only $300 million at their disposal. They have to sell the rights to everything, right, and they end up with nothing. They pay the IRS, and what do they have? So it's just
still have more than us combined.
Well, if you got to pay $1 billion and you have $300 million, maybe not.
That's pretty strong, anyway.
It's strong.
But you see our point. You need to have a will. If you have extensive assets, you really need to look at some trusts and some other vehicles that'll be in a more appropriate transfer of assets at death. or the vehicle still lives even if you die, and that way only money that you take out of it gets taxed when you take it out. And that is extremely important. So there's a lot of different estate issues, and you don't have to be a multimillionaire to have issues like this. Now, a lot of times I see these trust mills or these people doing seminars.
Yep.
All it is a trust mill. They're saying somebody with 30 grand needs a trust. What they're really telling you is anybody needs to pay us $5,000, $10,000 to create a trust because they're not needed in most instances. Let's say you do have $1 million, but you have a handicapped child you take care of or a grandchild. Then a trust, even if the assets aren't that large, you do have to have some kind of trust to take care of those other grandchildren or children.
And when you get over the lifetime exemption of $5.4 million is when it really becomes an issue, or you have a lot of real estate.
At least they changed that from $1 million before.
That's right, absolutely.
And if you have any questions, don't hesitate to call us at 972-715-2424. Stay with us, folks. We've got a break coming up. We're going to talk about income-producing investments after the break. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. It should say on common sense and not some BS like I hear everywhere else. But they probably fine us with the.
My word, what do you mean, Victor?
All right, let's talk about income-producing investments. It's getting really hard now to get any income from your investments, to get any interest on your interest-bearing investments, right?
A lot of people would blame the Fed and say that their QE, quantitative easing policy, helped Wall Street more than Main Street, and this is a real product of that, I think.
It's cost seniors in the last couple of years $417 billion.
Interest.
By the Fed keeping interest rates where they're at, not letting them float.
Yep.
And from all accounts, the Fed doesn't care about savers.
What's up?
They don't care about retirees in the least. What they care about is low interest rates keep the economy moving. People keep buying houses. Houses' values keep going up. They can expand businesses cheaper because the loans to expand the business much cheaper. That's what moves the economy. Even though credit card interest is still in the 20s for the average. That's why my banks are part of my axis of evil, because they'll pay you 0.1%, but charge you 20%.
I think
you go out of town. Yeah. You've always made everything on time. In one credit card, you forgot one payment or something because you went out of town or whatever. And now all of your credit cards hit this default rate, 28%, and that's somehow fair. So they are number one in my axis of evil. Airlines are one of them.
I'll agree with you on the banks.
Some of the property, even though we're a big property and casualty insurance agency, that anytime I got a policy on my house for 20 years, I make one roof claim. Now they don't want to insure me anymore. Come on. It's ridiculous. But all right, let's talk about income-producing investments.
Let's do it.
The pros and the cons.
Where do you want to start?
Let's go with the best ones, the bank accounts.
Bank accounts.
That's right, part of my axis of evil. Right now, you're getting an average 5-year CD is about 1%. I've seen full-page ads in Kiplinger, Money, Fortune in the last week. I read all of them, about 20 of them, by the way. They had some big, huge full-page ads, 2%, all internet banks. Yeah. Now, people out there, I know FDIC insured, they're FDIC insured, but I don't know about you, but if I can't go down there and talk to somebody, because a lot of these internet-based things, the customer service is horrible. You know, it's not like Amazon's got good customer service, but the rest of them, it's terrible.
If you can get a hold of someone.
That's right. If you're not getting a hold of a machine or somewhere in India or something, it annoys the crap out of me. But if you're okay with that, you can get up to 2%, and that's a full-page ad.
Remember when you were a kid and they had the actual piggy-looking piggy bank?
Oh, yeah.
And the little guy, the hunter that would shoot the penny across 3 inches into you'd actually get interest on your savings account.
What? What is interest on savings?
You'd actually get in, but now,
no,
not a chance.
So 1% to 2%. We know the risk. Banks reserve about 10% or less of your money, and so anything over $250,000 that's insured by the FDIC, you're kind of out of luck, right?
Now, I know
don't do it.
I know you're going to go through a lot of things, but our job here at Dillon Gage is to find the highest yield for you when you come at the time. It's different today than it was in 95. It's different in 95 than it was in 85. right now, if you're looking for a 3 to 5 year, something similar to this bank CD, fixed annuities again can pay closer to 3% depending on the high water mark and how much you
It's
have
not
to
CD
deposit.
type annuities, but just like 5 years, 3%.
Yeah, and you get and some of them will give you access to 10%, but it's just a better rate for the
It's a
same
tax
sort of
deferred
thing.
3 instead of a 1.
Yep. So,
That's taxable every year, but
just
they're pretty good.
throwing out an alternative.
Remember also when you have these bank accounts, when you have more than $250,000, remember split them up. Your name, your wife's name. Then you can also, they're called payable on death accounts or TOD, POD.
POD.
Also, you can put different beneficiaries on each type of account and get $250 for each one of those. So that's a good strategy to do if you have a lot more than $250. All right, then you've got municipal bonds. I've always been a big fan of municipals. I'm a series, what is it, 53, which is a municipal securities principle. So I know a lot about municipal bonds. I've always liked them. Right now, they're not really rewarding me for the risk I'm taking in them. Historically, municipal bonds have been pretty safe, but we've been in a lowering interest rate environment for decades. Over 30 years, interest rates have been declining. And so we haven't seen any defaults really.
And again, yeah, the only issue is defaults, or if you need to sell the bond to access the principal. If you hold them to term, you're fine.
That's right. So you got default rate, even though it's more minimal, in a rising interest rate environment, not only do you sell the bond at potentially a loss, you can have defaults go up exponentially when interest rates go up. It just happens, okay? And just because you see a 5% municipal when they know they're going 1 to 3,
right?
That's not an opportunity to buy. Typically, now they're suspect. Well, wait a minute, why are they paying 5 when everybody else is paying 3? It's kind of like going to the mortgage guy, and that's why people buy these mortgages all the time, REITs and all, and they go, all right, we got one paying 7. Well, that means you loan money that couldn't get 3. Somehow they've got horrible credit. People or companies have horrible credit, and you're buying into this. They're paying double the interest rate, and you think that's a great deal. Remember, paying more than normal is usually suspect.
6 months ago, we talked about Chicago's bonds. They had some high yield bonds.
Oh yeah, Chicago. Yeah. It's one of the worst economies there is, right? But 2% if you're in the highest tax bracket, 39.5, it equates to 3.5%. Actually, it's about 3.5%. But if you include that extra Medicare 3.8 tax, it's like 3.5. If you were getting 3%, it equates to 5%.
And if you have any questions on these,
tax equivalent yield.
We deal with them all the time. The best place to go is ilovemyretirement.com. You can fill out, ask a question. We can shoot you back an answer. Yeah. Be happy to do that.
Or call our hotline at 972-715-2424. We got a break coming up, folks. We're going to go through the rest of the income-producing investments when we return. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you have any financial questions you'd like to take advantage of our no-cost, no-obligation retirement, stress test, and written retirement plan, also our Social Security Optimizer, never hesitate to call our hotline at 972-715-2424 or go to our website, ilovemyretirement.com. All right, for the break, we talked about bank accounts. We're talking about income-producing investments. Muni bonds. Now let's go into the next set. Investment-grade bonds. Remember, this is triple B and better, or B++ and better, all the different ones.
Absolutely.
It's basically anything above a B. These...
Below that, they're called what? High-yield bonds.
That's right. We used to call them junk bonds, but junk bonds doesn't sell, so let's call them high-yield bonds.
Exactly.
It's the exact same thing. It's just like life settlements used to be called viatical settlements. Everybody lost their money on them. Then they called them life settlements. Now everybody's lost their money on life settlements. I don't know what they're calling them, but
it'll change. Yep.
Cheap, whatever. All right. Then you've got investment-grade bonds. What is an investment grade? That's a corporate bond.
You're loaning money to the
You're loaning money to a corporation. It's basically an IOU. This is different than a bank CD that's FDIC insured, and they reserve a portion of your money. Or like a fixed annuity where they reserve 100% of your money. In other words, the money's kind of sitting there if something happens. They don't reserve anything. It's just their promise to pay you a certain interest rate and your principal back at a certain time. Those obviously have higher risk in the risk scale. But they're paying you about 3 to 4% right now, average 10-year bonds.
And that's high now. How crazy is that?
That's considered a bonus. Remember, as interest rates go up, bonds go down. So you can't get the appreciation. Normally, let's say interest rates were higher. If they went lower, your bonds could go up, your price could go up. Right now, the interest rates really can't go lower.
Now, the interest stays the same. Victor's talking about the value of the underlying.
That's right. So the most you could get is your money back plus 3 or 4%.
That's right.
And sometimes you can sell bonds if it's a lowering interest rate environment. You can get appreciation plus the interest rate. Hope I didn't confuse you too much.
You get paid a premium because your interest coupon, your rate's higher than the.
Right. Well, I'll give you an example. Let's say you've got a 4% 10-year bond, and interest rates creep up, and new 10-year bonds are paying 6%. Well, does anybody want your crappy 4% bond when I get a brand new 6? No, unless you give me a lot lower price.
You got to sell it at a discount.
So the average yield will be close to the 6 again. In other words, give you $800 on that $1,000 bond.
That's right.
So that's what happens. Same thing as municipal bonds. Any interest rate sensitive things, you can have defaults exponentially. You got to be really careful on investment grade bonds. Historically, are pretty good, but you still got to be careful with them because some of them are tied into industries that are going a little rough patches right now. All right, the next one, real estate trusts. You heard we talked about this. I'm not a big fan of private real estate trust. Too much hanky panky goes on in there. Too much shadow ownership. Ridiculous charges for management.
Conflict of interest.
It's crazy. But you can get about 2 to 6% on them. The risk are there are lots of debt on these properties, and rising interest rates can make you lose money on that stuff. So be careful.
We've talked about this for the last 3 weeks, and I know there's good ones out there, and if they're not private, they've got a better chance. But again, they're very tempting because you can get 7 or 7.5% on your money. And make no mistake, you will get 7 or 7.5% on your money. When the banks are offering you 1, bonds are offering you 2 or 3, it's very tempting. But the secret is, or the hurdle is on these private ones, is getting your investment back. They have to go public. They have to create a market for you to get your money out, or you can't get it out.
It'll be one of those things. It's not a return on my money. It's just return of my money.
That's right.
Foreign bonds are the next. Foreign bonds. I hear this all the time. I have money in India. It's paying me 8%. I hear it all the time.
Used to be Mexico. I'm getting 30% in the bank.
Oh, I remember German bonds are paying a big amount.
Yeah.
Australian. Yes, you can get 6, 8, even 10% sometimes. But if you look at the currency versus the U.S. dollar, it's not even close. You would have been much better off getting 4% here than 8% in India. The U.S. dollar has strengthened that much against it. And so my point is, anytime you buy foreign bonds, you not only have the interest rate to worry about, but you also have the currency devaluation to worry about.
If that 10% was a real number, they'd have billions flooding. They wouldn't need any more money.
Now, if you're going to keep your money over there, blah, 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 and never bring it back, but remember, foreign bonds are not great. Remember that the deal that the economy of the entire world is not great right now. It's not horrible, but not great.
Right.
But we're that cleanest shirt in the dirty pile, and that's why I'm going to Europe here next month, and I'll be taking advantage of that euro the dollar being so much stronger, which will be great. All right, next one, preferred stocks. You get 4 to 7% on preferred stocks. A lot of people doing preferred stocks now. Preferred stock's kind of a hybrid between a stock and a bond. It's still a stock, still stock ownership.
They're callable.
It's not a loan, like a legal loan. Remember when you're breaking up a company and you got to order who's get the money?
Yep.
Last one, by the way, stockholders. They never get anything.
No.
But bondholders be numbered because that's a legal debt.
Right.
Preferred are higher than common stockholders, but still, I've never seen any preferred or common stockholders get anything in a thing. We'll talk about that more. We got a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Remember, folks, if you have any financial questions, if you'd like to take advantage of our no-cost obligation, retirement analyzer, retirement stress test, and written retirement plan, also the Social Security Optimizer, never hesitate to call our hotline at 972-715-2424. Again, 972-715-2424. You can go to our website, ilovemyretirement.com. There's some great videos on there and some good information. It changes weekly. Some of the research stuff on there. So it's a good resource for you. We're talking about preferred stocks right before the break. Right now, you can get about 4 to 7%. Remember, preferred stocks are kind of a hybrid between a common stock and a bond.
Right.
They don't get some people will argue it's the best of both. Some people argue it's the worst of both. Because remember, in a liquidation, they'll say, hey, it's better than the common stock if they're liquidating a company. But it wasn't as good as a bond. And with a bond, at least it's an IOU with a guarantee to pay, right?
That's right.
A preferred stock, they can change that thing anytime they want. And a lot of preferred stock was bought just for the dividend. This is a good example. A lot of these were big oil and gas guys, right? No, not so good. So there's still risk in there.
ConocoPhillips was great for the longest time.
They can eliminate the thing, do whatever, and the stock price can crash. Preferred stocks, even though they're decent, if you have a small portion of portfolio in them, you can't put everything in preferred stock. The average ones lost 40% back in 2008, just like everything else did.
And they're callable, and you still have the underlying value of the stock.
That's right. Anytime they get real good, they'll call them away. That's the way it is.
Well, yeah. They don't need the money, right?
Here's another income-producing investment, closed-end funds. Closed-end funds, unlike open-end funds, that's a typical mutual fund, is an open-end fund.
Well, you can keep
People
buying.
Just keep buying, right?
Yeah.
Basically, a closed-end fund, they buy a certain amount. In other words, they got $10 million in assets.
That's it.
That's it. Everybody buys $10 million. The good part, sometimes, when there's a demand, because what makes things go up or down is more buyers and sellers.
Supply and demand.
Buyers, that's right. If you have more buyers and sellers, it goes up. More sellers and buyers, it goes down. So sometimes you'll find some things that you can buy below their net asset value. And so you got a built-in cushion as far as risk goes and a built-in profit as long as everything works out. Some of the negatives with those things are some of them use leverage. In other words, they'll borrow money to buy more stocks to get them better potential gain. What does that do? Gives you more potential losses too.
And all this stuff should be disclosed to you at the time of purchase.
Right.
So.
And a lot of these closed-end funds will have a target. We're paying out 5%. If they don't, it's in their charter. They'll start paying you part of principal back. And so getting my principal back when I think I'm getting 5% interest is not the greatest thing, but that can happen. All right, here's another income-producing. High-yield bonds.
Now we're talking.
High-yield bonds, 6 to 8%.
I like it. Nice rate,
right.
Anyway.
That's right. But remember, it's like loaning your, dumb cousin Eddie money that's never paid his bills on time. He's got horrible credit. When you got that 850 FICO, his is like half of that. And nobody will loan him money, but you're going to do it.
Now, you and I have both done that
yeah.
as family members. I know.
Oh, yeah.
And when you do it, you write the check and you go, it's not
gone.
Coming back. It's gone.
People come to me all the time. Well, I loaned this money to my. I'm like, really? You expect that back? Oh, yeah, they're going to pay. Okay.
That's right.
All right. But high-yield bonds have the risk, interest rate risk, default risk. We haven't seen as much because interest rates have gone down so much. So it's easy for a company, even with bad credit, to refinance some bad debt because if they can't make this payment, they can get a lower payment by refinancing it to a lower payment.
Getting a lower rate.
That's right. When interest rates are going up, which they have to eventually, they can't refinance for a higher payment.
And that's when the defaults will go up.
That's when your defaults go up exponentially. So be very careful right now with interest rates where they are and the market point, capping out in here. Kind of, if you look at a chart, went up for about 5 years in a row. The last two, it's kind of just set up here. It's back and forth a lot, but it's just set up.
They're calling it a bunny market because it hops around so much. That's volatility.
Right. So be careful. I don't think right now I'd buy a municipal bond or bank account or a fixed annuity way before I'd buy a high yield bond right now. Understanding that, yes, the high yield bonds pay a lot more, but there's a lot of risk right now. Okay. Master limited partnerships. Sometimes you get 5 to 11% of these. Problem with them, sometimes they got pretty shaky balance sheets. They always have to raise more capital for expansion, and a lot of master limited partnerships are based on the oil and gas industry, and we know what's happened there.
Not a problem with those, and you talk about them having to raise money. If they don't raise money, if they don't get more income that way, they can't keep going, and they default.
There was an article in Think Advisor. It was a professor talking about the aging of America and what kind of problems that has solved. Everybody's heard where all the baby boomers, we're baby boomers, and as they retire, what it's doing to the economy. But I'm going to give you a couple statistics to put everything in perspective. When the U.S. Constitution was crafted, the average life expectancy in the United States was 36 years old. And to think, well, that was so long ago. At the turn of the century, 1900 or whatever, not the 2000 one, but the 1900 one.
I know.
It was only 42. So in that couple hundred years,
6 year difference. That's
100
crazy.
something years. Yeah, didn't go up in 6 years.
Yeah, 6 years.
Now let's move to today. 10,000 baby boomers turn 70 every single day. And by the way, the average person in America when the Constitution was written was 16. That's pretty crazy, isn't it? But there was no anticipation of this age wave.
I wonder what the population was of America back then. Anyway,
It wasn't much.
No.
But it was more than I thought, but not,
Right?
But right now 42% of the federal budget is spent on Medicare and Social Security. 42%. It will exceed 50% in the next 10, 15 years. And that's not going to go there. So anybody tells you they're not going to change Medicare, they're not going to change Social Security, blah, blah, blah. It'll always be there. You can't. That's too big of an entitlement program, but it will be changed. There is no way. But you've got to look at all of these different issues when you're planning for retirement. And that's why I'm bringing this up, is the economy, as far as these retirement plans, are still stuck in 19th century notions of longevity and age. Remember when Social Security was created, you know what the average age was of life expectancy? 62. Isn't that funny how they started it at 62?
Didn't plan to pay anything, did they?
That's right. Well, stay with us, folks. We're going to break. We're going to say more about this topic. Don't hesitate to call our hotline, 972-715-2424, or go to ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you'd like to take advantage of our no-cost, no-obligation retirement stress test, retirement analyzer, don't hesitate to call our hotline. It's 972-715-2424. If you'd like to make sure you're making the right decision with your Social Security, actually look at the numbers. We provide that at no cost or obligation as well. 972-715-2424 or ilovemyretirement.com. Sorry,
and remember, we work with all age people all across the board, but if you're in that sweet spot where you're 10 years prior to retirement, it really, what determines how much money you're going to have, or your paycheck in retirement is what? How much money you've saved, what your interest rate is, and how long you can defer it. Well, if you've saved the money, if you can have 10 years to defer it, it almost doubles the amount of money. So anyway, short story long, if you're in that sweet spot where you're about 10 years from retirement, it's an ideal time to make some positive decisions if you haven't already.
We're talking about Social Security was invented, the life expectancy of a human.
62?
62 years old. And it's funny how they triggered. Okay, you can start at 62.
Your life that'd be like saying today it starts at 80.
And here's what they were doing. For every one person that turned 62, there were 42 people paying for that person's Social Security. What do you think it is now, Guy?
2 to 1?
3 to 1.
That's close.
There's only 3 people paying for the same person. And so they're trying to say, well, maybe 65 is it? Maybe 65, 70, 80. Pretty soon Social Security is going to give full retirement age at 80 or 85.
That sounds a lot like government or political math.
That's right. Remember, I always tell you, there's two. If you're a politician, they want to stay in office more than their own agenda. And there's a couple of demographics you don't want to mess with. I've always said Hispanics, that's a very fast-growing demographic. Another one is older people.
Yep.
Right now, they're 46 million. They expect to double in the next 20, 30 years. Double the population of older people. People are living longer. Heck, they'll keep you alive longer in a nursing home, even though you don't want to be alive, right?
That's right.
And so all of those changing demographics, it points to me one thing. Nobody's going to save you in retirement except you. So that's why it reinforces what we say here at Dillon Gage. Guarantee your expenses. Account for inflation. Save as much as you can. And do things the right way. Does it make sense that you're going to put 100% of your money in the stock market? I love the stock market. Remember, I have money in the stock market.
We've got some
I
great
manage money in the
We've got some great managed programs in the stock market.
Does it make sense? You're about to retire. Let's say you're 65. I've got on 100% individual stocks. Victor, I don't care what you say. I've been doing this forever and I've done great. Does that make sense that to pay your bills, the stock market has to continue doing this? Or if you're very successful at stock market trading or whatever, You have to continue this. It also says there is an epidemic in this country of Alzheimer's. It's going to affect 1 in 2 of you by the time you're 80. And so, even though it might not be in your family, remember, people are living longer. All of these older diseases are now much more prevalent. And so you've got to protect yourself not only against what the stock market does, what interest rates do, what the economy does, what happens geopolitically around the world, but also from yourself. Because who knows? It's one of those things. I know I'm going to be clear till you don't know, right?
That's right.
Then all of a sudden you're like, oh, what am I doing? And you've got, let's say one spouse handles all the finances. And all of a sudden that spouse goes crazy and blows everything and said, hi. Well, the other spouse is going to have to live that way now.
Well, and the problem is with the surviving spouse, if the surviving spouse is not the one that's taking care of the finances and knows what's going on and knows where everything is, first off, they can miss a couple of things, but more importantly is they can get some bad advice. They can see a commercial or something on the television. They really don't know who they're calling. These guys sound great. They're smooth. They've got a good office. And one bad decision just completely changes, could ruin their retirement.
I have people all the time that come to me and said, both my parents died before this age. My wife's parents died before. There is no way I'm living past 80 years old. So they're 60 now, and I've done a 20-year payout on everything. I don't care. It's 20 years, and that's what I'm going to get. Or I've had them do it 10 years. I go, okay, you can live with that plan, but here's the problem I always worry about. Okay, I live one day more, just one day, not a year, one day more. That one day, I can't imagine being the most miserable thing in my life. I know I'm broke. It's over.
Mm-hmm.
I have nothing. And you're going to have to live on Social Security, which maybe you've got really, really low expenses. You don't go to the store. You don't go out to eat. You don't go anything. But Social Security doesn't pay a whole lot. Not in today's world.
If you take care of your income and you use our retirement analyzer, not only does it take your money from lasting to 80, if you think you're only going to make it to 80, to maybe 100, but more importantly, you may have income off of that money that only lasts to 80 of, let's say, $2,000 or $3,000 a month. I'm just pulling that out of the air. With our plan, perhaps you could double that and have $6,000 or $7,000 a month till 80 and longer if needed.
I called this the Common Sense Investing Show. It's been my mission because I've seen too many people close to me that made great amounts of money and then end up with nothing because they kept pumping it into what they know. And what you know is not the problem. It's what you don't know that's the problem. And so you need to account for things you know and account for things you don't know. And that's why having a written plan and talking to somebody is so important. Call us at 972-715-2424. And we can schedule a consultation. It can be on the phone or in person, whatever you'd like. And let's see if your situation, if you have those kind of problems, potential problems. Again, 972-715-2424. Or you can always go to our website, ilovemyretirement.com. You can also call me toll-free, 1-800-McClure. I want to thank everyone for listening this Saturday, just like every Saturday. Guy and myself, we always, always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.